faithfully delivering value by interpreting the world's best books. Hello, this is Sally Book Talk. Today I'll interpret the book, The Golden House, for you. It also has a subtitle, Top Hedge Fund Traders, How They Profit from Global Markets. In media reports, hedge funds are mysterious, low-key investment institutions. On one hand, they bring huge wealth to investors. On the other hand, they cause turmoil in financial markets. That They've even triggered crises in some countries and regions. Hedge fund managers are often described by media as financial tycoons who manipulate markets, frequently making headlines like Soros and Rogers of Quantum Fund, Dalio of Bridgewater, etc. But why are these big shots more skilled than regular traders? How do their hedge funds operate and profit? The vast majority of the public still doesn't understand it well. So today, this book aims to unveil the mystery of hedge funds and explain their trading secrets. The author of this book, Stephen Drobny, worked early on in Deutsche Bank's hedge fund group in London, Singapore, and Zurich. Later, he founded Drobny Global Advisors, specializing in economic research and analysis, with clients being globally renowned hedge fund companies. As we know, top traders generally don't like to share their experiences and money-making secrets. But Drobny has deep connections in this field. He successfully got the big shots to talk. This book is an interview collection featuring 13 renowned fund managers in the hedge fund industry. Their backgrounds vary greatly, including former heads of Goldman Sachs trading department, Barclays Bank finance directors, Bank of England officials, stock traders, commodity experts, currency specialists. Some aren't from a financial background. They were sociologists, soldiers, workshop supervisors, bar owners. It's unclear if this was the author's intentional choice. However, these diverse backgrounds provide us with multiple, rich perspectives to understand hedge fund trading. In the interviews, the big shots discuss the development of the hedge fund industry, their own investment experiences, and share their preferred trading methods and proudest success stories. Thus, the book records a wealth of vivid first-hand information. Today, I'll extract 3 key aspects to interpret for you. First, what exactly is a hedge fund and what makes it special? Second, what are their commonly used trading strategies? Third, how do they operate? Let's start with the first part. What exactly is a hedge fund and what makes it special? As mentioned earlier, many big shots interviewed in this book previously worked at other funds or financial institutions before founding their own hedge funds. And when discussing this career choice, they all shared one reason. Hedge funds offer maximum freedom to fully utilize their investment talents. Why do they say that? Because hedge funds have 3 unique characteristics. First, they have broad investment scope. They can invest in any country, region, or financial market, whereas regular funds are often limited to specific national markets, like only investing in Chinese stocks. Typically, hedge funds invest across stocks, futures, forex, bonds, options, and more. They freely shift between these instruments based on market changes. For example, as Sushil of Wadhwani Asset Management stated in the interview, investors authorize hedge fund managers to do whatever they see fit. The second unique aspect is their frequent use of leverage, borrowing money to amplify investment scale. A regular fundraising $1 billion invests only $1 billion, while a hedge fund might borrow another $1 billion to invest $2 billion total. And this doubled leverage amplifies potential returns. Soros used 13 times leverage when shorting the British pound in 1992. Unthinkable for regular funds, but common in hedge funds. The third uniqueness is their heavy reliance on short selling and hedging strategies. Short selling involves borrowing shares to sell immediately, then repurchasing them cheaper later to return. Selling high and buying low allows profiting from price declines. Hedge funds dominate short selling. Players like Soros exemplify this. Their 1992 pound short and 1997 shorts on East Asian stocks and currencies cemented their reputation as major short sellers. Now, about hedging. It's a trading technique that, simply put, involves two opposite trades. For example, if I buy a ton of white sugar but fear its price might drop, I then buy a futures contract betting against sugar. That's a simple hedge. If sugar prices fall, the profit from the futures contract can offset the loss on my physical sugar. Hedging helps avoid risks, lock in profits, and enables sophisticated trading strategies. We'll elaborate on this later. For now, we can think of hedging as placing bets in both directions. That concludes the three unique aspects of hedge funds. Actually, hedge funds aren't new. Their history traces back to British economist Keynes and American investor Graham. But modern hedge funds evolved from two investment schools post-World War II. The first is the equity school. In 1949, American Alfred Jones founded the first modern hedge fund, primarily investing in stocks, achieving nearly 50-fold returns over 2 decades. In 1966, Fortune magazine published the famous article, "Nobody Does Better Than Jones," first publicly introducing Jones' strategies and performance. This article attracted numerous investment elites who launched hedge funds. Later, quantum funds, Soros and Rogers, and tiger funds, Julian Robertson, all became followers of Jones. The second school is commodities, meaning commodity futures like metals and agricultural products. This school was pioneered by American Helmut Weimar. In 1970, Weimar founded Princeton Commodities Corporation, pioneering global investments across commodity markets. Later, legendary fund managers like Michael Marcus and Paul Tudor Jones emerged from this company. By the 1980s, hedge funds reached a pivotal moment when both schools independently underwent a transformation. These schools ultimately shaped contemporary hedge funds. This transformation was adopting global macro strategies and trading. Global macro strategies involve trading based on analyzing global economic, political, and social factors. Simply put, it's about paying attention to major global events. Based on how these events affect financial markets, they develop trading strategies to find investment opportunities. For example, after Brexit, will the British pound appreciate or depreciate? When the U.S. implements quantitative easing, will the dollar index rise or fall? How will the China-U.S. trade dispute affect both countries' stock markets? The rise of global macro strategies stems from massive global trade growth, which interconnected financial markets worldwide, allowing major events anywhere to rapidly impact global prices. Right, so meanwhile, the collapse of the dollar-centered fixed exchange rate system intensified currency fluctuations, forcing both equity and commodity traders to hedge exchange rate risks.
For example, a U.S. fund investing in Japanese stocks might gain on shares but lose overall if yen depreciation erases profits when converting to dollars.
Because ultimately, profits must be converted back to dollars. To avoid such risks, macro factors must be considered in trading. That covers the background context. From an internal development perspective, financial liberalization spurred numerous innovative products,
Such as Eurodollar futures, standardized options, contracts, etc.
These innovations provided diverse tools for implementing global macro strategies. Virtually every hedge fund interviewed employs global macro strategies.
Hence, they're termed global macro hedge funds in the book.
All right, that concludes our hedge fund overview. Now let's explore part 2, their trading strategies. Each of the 13 experts has unique specialties. The book reveals 2 widely used strategy types: directional trading and relative value strategies. Let me break these down for you. First, directional strategies. Directional meaning a clear market bias. This resembles conventional trend trading. Trend trading predicts whether markets will keep rising or falling, then trading consistently in that direction. For example, in commodity futures, predicting iron ore prices will keep climbing. You'd consistently buy long positions without changing direction. Unlike regular funds trend trading, directional strategies focus on long-term macro trends. First, what exactly is a hedge fund and what makes it special? Second, What are their commonly used trading strategies? Third, how do they operate? Let's start with the first part. What exactly is a hedge fund, and what makes it special? As mentioned earlier, many big shots interviewed in the book previously worked at other funds or financial institutions before founding their own hedge funds. When discussing this career choice, they all shared the same reason. Hedge funds offer maximum freedom to fully utilize their investment talents.
Why do they say that?
Because hedge funds have three unique characteristics. First, they have a broad investment scope. They can invest in any country, region, or financial market, whereas regular funds are often limited to specific national markets, like only investing in Chinese stocks. Typically, hedge funds invest across stocks, futures, forex, bonds, options, and more. They freely shift between these instruments based on market changes. For example, as Sushio of Wadhwani Asset Management stated in the interview, investors authorize hedge fund managers to do whatever they see fit. The second unique aspect is their frequent use of leverage, borrowing money to amplify investment scale. A regular fundraising $1 billion invests only $1 billion, while a hedge fund might borrow another $1 billion to invest $2 billion total. This doubled leverage amplifies potential returns. Soros used 13 times leverage when shorting the British pound in 1992, unthinkable for regular funds but common in hedge funds. The third uniqueness is their heavy reliance on short selling and hedging strategies.
Short selling involves borrowing shares to sell immediately, then repurchasing them cheaper later to return. Selling high and buying low allows profiting from price declines. Hedge funds dominate short selling. Players like Soros exemplify this.
Their 1992 pound short and 1997 shorts on East Asian stocks and currencies cemented their reputation as major short sellers. Dollar policy affects almost all commodity price trends, while in forex and bond markets, major moves are often driven by central bank policies. Now, for example, when central banks start rate cutting cycles, it fuels bond bull markets. Similarly, interest rate differential trends between the US, EU, Japan, and others impact global exchange rates. Hedge fund titans are hypersensitive to global events, excelling at instantly assessing their market impact. During 9/11 in 2001, Christian from Supermarco was still a prop trader at Goldman Sachs. After the first plane hit the World Trade Center, he immediately knew it wasn't an accident. Christian noted the clear NYC weather. As a former pilot, he knew emergency landings target open areas, not skyscrapers. He instantly concluded this was unprecedented terrorism that would crush market confidence.
Before the second plane hit, he bought call options on government bonds, the safest assets.
When the attacks were confirmed, massive capital flooded into bonds for safety, spiking prices. Christian earned huge profits that year. Facing September 11, Everest Capital's Marco acted slower but spotted an overlooked opportunity. Analyzing 9/11's impact, Marco reasoned U.S. counterterrorism would need Pakistan's support, bringing aid that would boost its currency and stocks. He bought Pakistani stocks, and the currency appreciated while shares surged. All right, that covers macro strategies for directional trading. The second key point is using hedging to avoid risks, especially tail risks. Tail risks resemble black swan events, extremely improbable but devastating when they occur. Yet when they strike, the danger is catastrophic. For example, the 1998 Russian bond default mentioned in interviews. Before it happened, nobody believed Russia would default. It wasn't Russia's creditworthiness being high, but because those bonds were denominated in rubles.
Logically, for domestic currency bonds, they could just devalue the ruble and print money to repay. Why default?
Yet, unexpectedly, Russia both devalued and defaulted, causing massive losses for many European or American hedge funds and plunging the industry into crisis. Next, we'll examine how hedging mitigates risks through a case study. This example comes from Marco of Everest Capital, who held substantial East Asian stocks. When evaluating the trade, he identified a tail risk. If severe conflict erupted on the Korean peninsula, capital flight could crash regional stock markets. Regular stock funds rarely prepare for such risks.
But Marco addressed this seriously by buying North Korean credit default swaps, essentially specialized insurance.
If conflict occurred, he'd receive massive compensation to offset stock losses. Remarkably, since few bought this insurance, his premium was cheap, hedging tail risk at minimal cost. All right, that covers directional trading strategies. Now to the second strategy, relative value trading, which arbitrages price gaps between correlated assets. When one asset is overvalued relative to another, buy the undervalued and short the overvalued, closing positions when valuations converge for profit. This works because valuation gaps are temporary distortions. Markets eventually correct them. In 1949, Alfred Jones founded the first modern hedge fund using this strategy. He primarily employed this approach initially. Jones bought unvalued stocks while shorting overvalued ones.
These correlated stocks typically rise together in bull markets and fall in bear markets.
But regardless of market direction, valuations converge. Undervalued stocks outperform in bulls and decline less in bears. This way, Jones's trades always made money. Why? First, consider bull market performance. Suppose undervalued stocks rise 20% in a bull market, while overvalued ones rise 10%. Closing positions. Long positions gain 20%, shorts lose 10%, netting 10% profit.
Now, in a bear market, if undervalued stocks drop 10%, long positions lose 10%.
But overvalued stocks might plunge 20%. Shorting them gains 20%, netting 10% profit after offset. Jones's trade reveals a key feature of relative value strategies: independence from market direction.
Meaning we ignore overall market movements, only tracking relative price action between assets.
Another case comes from Dwight at Osprey Management. He was a star manager at Tiger Fund. Post-2000 NASDAQ crash, most investors feared recession would drag down real estate, but Dwight favored mid to low-tier real estate stocks. Their affordable housing was essential, less impacted than luxury properties. Plus, these stocks were deeply undervalued. However, U.S. economic and market risks remained high. What to do? Dwight designed a relative value strategy. Long real estate stocks, short auto stocks. The logic: real estate stocks were cheaper than autos, and housing is more essential than cars. Thus, if property stocks rose, auto stocks would underperform. If recession hit severely, autos would suffer more than housing. Auto stocks would fall harder. Either way, the trade profited, far safer than solely owning real estate stocks. Now let's examine relative value strategies in commodity futures markets.
We'll briefly cover two methods: intermarket arbitrage and cross-commodity arbitrage. Both employ hedging.
First, let's look at intermarket arbitrage. It means buying low and selling high when the same commodity has significant price differences across markets. For example, if copper prices are higher in Shanghai than London, you buy in London and short sell in Shanghai. Normally, after accounting for costs and exchange rates, the price gap should narrow. So, regardless of overall copper price movements, the trade profits. Cross-commodity arbitrage involves related goods like barley or oats or soybean oil, substitutable with similar supply-demand factors. They're highly correlated, so price movements should stay reasonably synchronized. If divergence occurs, say soybeans double while soybean oil stagnates, buy soybean oil and short soybeans. Two caveats about relative value strategies.
First, while valuation convergence is probable, gaps can persist or widen under special conditions.
Second, determining over or undervaluation can be straightforward, like London versus Shanghai copper, but often relies on subjective judgment. In stocks especially, no single objective standard defines over or undervaluation. Judgments depend on statistical patterns or metrics, which aren't foolproof.
All right, that concludes part 2.
Now to part 3, how hedge fund managers work. Recall Scott, Quantum Fund's London chief, who traded with Soros and Druckenmiller. He later launched his own fund with $1 billion.
Basin says fund managers resemble journalists, gathering information to form views, but journalists write articles while managers trade. The experts echo Scott, forming independent market views is the most crucial trading skill.
Specifically, they pay intense attention to what's wrong in the markets.
For instance, when markets should rise but don't, is that a directional long opportunity? When two assets' valuations diverge excessively, could we arbitrage the spread? As Peter Thiel, Korean Capital president and PayPal co-founder, put it, a hedge fund manager who feels he lives in a normal world has nothing to do.
Only by seeing market distortions can one find huge opportunities. So how to form such views?
The author asked nearly every expert this question. Answers fall into three categories. First, broadly gather information: media, articles, institutional reports, academic papers, statistics, data sheets, etc. Additionally, managers leverage networks, consulting experts, government advisors, economists for deeper insights. But crucially, avoid rumors. Dwight of Osprey shares a cautionary tale.
In 1999, newly launching his fund, Dwight was long gold.
One night, after an industry event, he helped a drunk man on his way back to the hotel.
A drunk, grateful claimed to be with Soros and warned,
Don't go long gold next week. Dwight was already anxious about gold's direction. This seemed divine intervention. Feeling rewarded for his good deed, he immediately closed his gold positions, believing he'd received insider info. Predictably, no Soros connection existed. Gold rallied strongly, costing Dwight the trade.
This wasn't some rookie mistake. The Dwight had years of experience, yet still lost what should have been profitable.
He fell victim to wishful thinking, forming trading views based on baseless rumors.
Second principle: seek truth through hands-on investigation. Dig for fresh data and critical details.
Like when Dwight traded palladium at Tiger Fund in the mid-90s, a key material in nuclear aviation tech. To grasp palladium's price trend, Dwight first needed to understand its supply-demand dynamics. Data showed an annual supply shortfall reaching 25% of demand. Prices should double if this continued, but was the data accurate? Could the gap be filled quickly? Public sources offered no answers. He had to investigate personally.
At the time, 60% of global palladium came from a major mine near Siberia's Arctic Circle.
Dwight traveled there and uncovered a crucial hidden detail during deep investigation.
Russian export firms, finance ministry, and central bank were locked in a power struggle over export rights, restricting each other. This made effective supply expansion impossible short-term. With this insight, Dwight went long. Palladium prices surged ninefold over subsequent years. Dwight profited enormously, cementing his trading philosophy. Third principle: after gathering information and data, deduce market trends using fundamental economic laws. In Dwight's palladium trade, once confirming supply couldn't increase, economics price theory dictated that scarce supply would naturally drive prices up. Thus, going long became the logical conclusion. When deducing trends, note: first, avoid simplistic historical comparisons, e.g., last supply crunch doubled prices, so this one will too? Not necessarily. It might more than double or rise just 10%. History doesn't repeat exactly. Analyze current conditions specifically. Second, use technical charts and capital flows to time trend entries. Economic principles predict broad trends, but their initiation may lag. E. Gently, CME's Harris told of a manager who sent investigators to Africa, discovering dire cocoa production. He inferred rising prices, bought cocoa futures, prices quadrupled, yet he went bankrupt. Why? Because cocoa first crashed before surging. This fund manager's positions were wiped out during the decline, collapsing just before dawn. All right, that covers forming market perspectives. Now let's discuss fund managers' other crucial task: risk management. As mentioned, hedge fund leverage is double-edged, and short selling is particularly dangerous. Theoretically, its gains are limited, while risks are unlimited.
For example, shorting a $10 stock, it can only fall to zero, but might soar to $100 or $1,000.
Meaning maximum gain is $10, but potential losses could be tens or hundreds of dollars. Given these high-risk operations, fund managers prioritize risk management. So how to manage risk? We'll explain in 2 phases. Phase 1 is pre-trade. Phase 2 is post-entry. First phase, exhaustive preparation. As Rogers says, over-prepare and consider all relevant information. Overlooking key information spells disaster from the start, as Rogers learned painfully. In 1980, moments before the Iran-Iraq War erupted, he shorted oil. Reports of Iraqi troops amassing at the border were right in his hands. Rogan's recalled. With slightly more diligence, he'd have sensed impending conflict. Oil trading's first rule: Middle East conflicts disrupt supply and spike prices. But complacency blinded him to this crucial insight. Now to phase 2. Once in a trade, continuously monitor it.
Watch for changing conditions, especially factors working against your position.
As Christian of Supermarco says, ask yourself every morning why you still hold this trade. If your original thesis no longer holds, exit immediately.
Additionally, set strict stop losses, exit decisively when triggered.
Gently. Buying a stock at $10, set a stop loss at $9. If it drops to $9 instead of rising, sell immediately and accept the loss. All right, that concludes part 3. We've covered the essence of this book. Briefly recapitulative, informative tone. Compared to regular funds, hedge funds have broader investment scope, diverse trading methods, and prefer high leverage with short selling or hedging techniques. Their main trading strategies are directional and relative value strategies. The former trades price trends, while the latter trades relative price movements between assets. Hedge fund managers master economic principles and possess extensive trading experience. They excel at forming trading perspectives from diverse information to generate substantial profits. All right, that completes our interpretation of the Golden House. Reading notes are below the audio. We'll see you tomorrow.